Looking to invest in the kind of business that almost can't lose over the long run? Want a dividend that beats the market while also growing at a double-digit rate? Interested in buying a dividend growth stock while it's on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a world leader in providing products that underpin the global food supply. We've all got to eat, right? Well, there's a lot that goes into the global food supply, like ingredients. Yes, ingredients. You know, like that list of ingredients on the back of almost every food package out there? Yeah, this company is a global leader in ingredients. Because of that, it's been growing and looks like it's growing even faster across its revenue, profit, and dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Ingredion Inc., which appear to be trading at a significant discount today. Ingredion Inc., stock ticker INGR, is a leading worldwide ingredients solutions provider. Founded in 1906, Ingredion is now a $6 billion by market cap ingredients powerhouse that employs 12,000 people. Fiscal year 2021 sales are geographically segmented as follows: North America 60%, South America 15%, Asia Pacific 15%, and Europe, Middle East, and Africa 10%. Product categories are as follows: starch products 45% of fiscal year 2021 sales, sweetener products 33%, and co-products and others 22%. Ingredion turns raw materials like grains, fruits, and vegetables into value-added ingredients and biomaterials for various industries. Ingredion also provides products for the animal feed and corn oil markets. Examples of their products include industrial starches, high fructose corn syrup, dextrose, and refined corn oil. All in all, Ingredion supplies a variety of customers in over 60 industries across the world. The food industry is their most important industry, representing about 54% of fiscal year 2021 sales. What I really like about Ingredion is the simple to understand business model. While some investors just can't help themselves from chasing after shiny objects they don't fully understand, Ingredion is supplying the world with simple yet critical ingredients, and the company making a lot of money by doing so, more and more money in fact, and so are shareholders. And I don't see that changing as the world's population continues to grow and demand more of the end products the company's ingredients are necessary for. That should translate to growth across the company's revenue, profit, and dividend. Already, Ingredion has increased its dividend for 12 consecutive years. The company's 10-year dividend growth rate is 15.8%. That's quite strong, although the size of dividend raises have been slightly lumpy along the way. Zooming in on that, the most recent dividend raise was 9.2%. Either way, shareholders have likely been very happy with the dividend and the growth of it. Along with the strong rate of dividend growth, the stock yields a market-beating 2.9%. That yield is 10 basis points higher than its own 5-year average, giving investors a bit more of an income kicker than they're used to getting here. And with the payout ratio at 39.3% based on midpoint guidance for this fiscal year's adjusted EPS, I see a healthy dividend with headroom for more growth ahead. I always like dividend growth stocks in what I call the sweet spot. It's a yield of between 2.5% and 3.5% paired with high single digit or better dividend growth. This stock is clearly right in the sweet spot. Looking at business growth, Ingredion advanced its revenue from $6.5 billion in fiscal year 2012 to $6.9 billion in fiscal year 2021. That's a compound annual growth rate of 0.7%. I'd prefer to see a higher number here, but a great business can pull multiple levers in order to drive better bottom line growth. To that point, earnings per share grew from $5.47 to $6.67 adjusted over this period, which is a compound annual growth rate of 2.2%. I used adjusted EPS for fiscal year 2021 because of significant one-time items that artificially skewed GAAP earnings per share. One of the aforementioned levers that a business can pull is, of course, buybacks. Ingredion did reduce its outstanding share count by approximately 12% over the last decade, which is respectable. Like the dividend growth, EPS growth has been somewhat inconsistent over the last decade, and so the impressiveness or lack thereof does depend on the starting and ending points you're using when drawing a line and looking at growth. But I think there's an important point to make here. If we look at more recent results, Ingredion has shown an acceleration in top line and bottom line growth, and that acceleration in growth could be just warming up. Fiscal year 2021 was a record year for the business in many ways, with past efforts by management finally bearing fruit, pun not intended. The company's quote-unquote cost-smart cost-cutting program is restructuring the business and taking out costs. Meantime, the quote-unquote driving growth roadmap is a growth investment initiative is all about creating more value by investing in core competencies and better serving customers. Lowering costs while simultaneously increasing sales is a recipe for higher earnings power. Ultimately, we invest in where a business is going, not where it's been, and the business's path forward appears to be more exciting than the path already traveled. CFRA believes that Ingredion will compound its earnings per share at an annual rate of 10% over the next 3 years. This speaks on the acceleration in growth that I was just pointing out. CFRA's prediction can be largely backed up by Ingredion's own adjusted EPS guidance for fiscal year 2022, which was increased in the Q3 print to $7.23 at the midpoint. That would represent 8.4% year-over-year growth. CFRA adds this, and I quote, "We see Ingredion as well positioned to capitalize on new consumer trends as the company has invested millions of dollars over the past several years in areas like plant-based foods, sugar reduction, and specialty starches. In 2023, we see solid sales growth and strong margin recovery, particularly as Ingredion passes on more cost-justified price increases," unquote. Ingredion is right-sizing an improved business with increased capacity for right-sizing prices. I personally see more benefits than drawbacks here. On one hand, the business is looking at the secular decline of high fructose corn syrup, and the commodity-like nature of the core business model is a negative. On the other hand, natural sweeteners should see an increase in demand. The company's growing portfolio of specialty ingredients offer greater pricing power, and investments in plant-based proteins position the company for growth. Regarding the last point, Ingredion recently acquired the remaining stake of Verdient Foods Inc. that it didn't already own, giving Ingredion the ability to produce concentrates and flours from peas, lentils, and faba beans. This business is situated much better in 2022 than it was a decade ago, and that bodes well for the next decade. We can see that the company's 10-year dividend growth rate is quite a bit higher than the demonstrated 10-year EPS growth rate. If CFRA's forecast is realized, that will go a long way toward rationalizing management's behavior and fixing this gap. It also sets the company up for at least high single-digit dividend raises over the foreseeable future, and stacking that on top of the near 3% starting yield is a solid setup. Moving over to the balance sheet, Ingredion has a good financial position. The long-term debt-to-equity ratio is 0.6, while the interest coverage ratio is nearly 9. Profitability, quite acceptable. Over the last 5 years, the firm has averaged annual net margin of 5.7% and annual return on equity of 13.2%. These averages would be higher if not for the anomalous fiscal year 2020 throwing them off. Overall, I see a really good business here that's on the cusp of greatness, and with economies of scale, switching costs, and pricing power in a growing portion of the portfolio, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The company is exposed to volatile input costs. Currency exchange rates affect the international side of the business. High fructose corn syrup, which which comprises about 10% of sales, has faced concerns over its possible links to certain health issues like diabetes. There has been a consumer movement towards simpler foods with less ingredients, which does not work to Ingredion's advantage. Also, the balance sheet is not excellent, limiting future M&A opportunities. I do see the risks here as quite manageable, especially when viewed against the quality of the business, and with an attractive valuation, the case for investment is made to be even more compelling. The stock is trading hands for a price-earnings ratio of 14.6. This is a very reasonable earnings multiple, particularly with the way in which underlying growth seems to be accelerating. It's well below the broader market's earnings multiple, even after the severe compression of the broader market's PE ratio this year. We can also see a price-to-sales ratio of 0.8 that compares favorably to its own 5-year average of 1, and the yield, as noted earlier, is slightly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This dividend growth rate looks aggressive in the face of the demonstrated EPS growth over the last decade, but it looks conservative against the demonstrated dividend growth over the last decade. I'm splitting the difference here, and I also have CFRA's near-term EPS growth forecast in mind, with the payout ratio being where it's at, and with recent earning reports validating CFRA's stance. I don't see why Ingredion can't produce high single-digit dividend growth over the years to come. The dividend discount model analysis gives me a fair value of $122.12. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Ingredion as a 4-star stock with a fair value estimate of $120. CFRA rates Ingredion as a 4-star buy with a 12-month target price of $113. We have a fairly tight consensus this time around, and I came out very close to where Morningstar is at. Averaging the three numbers out gives us a final valuation of $118.37, which would indicate the stock is possibly 22% undervalued. Here's the bottom line, guys. Ingredion Inc. is a really good business that appears to be on the cusp of greatness. It looks to be in the midst of turning a corner, and investors jumping on now could be in for a profitable ride. With a market-beating yield, a double-digit long-term dividend growth rate, a low payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 22% undervalued, long-term dividend growth investors ought to consider buying a slice of this business before the market reprices it higher. And now for a special news announcement. Nestle SA, stock ticker NSRGY, just updated investors on its growth target. And boy, what a wowzer. Nestle, which is the world's largest publicly traded food company, now expects sales to grow organically between 8% and 8.5%. That's incredible sales growth for a company this big. Its market cap is over $300 billion. Also, the company intends to repurchase 20 billion Swiss francs worth of shares, which is about $21.1 billion from 2022 through 2024. That's more than 6% of the entire company's market cap. This company doesn't get a lot of press, and I've been guilty of not covering it much myself. There are just so many great businesses out there to talk about here, but Nestle is doing great things. Take a look at it.
Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.